So David, does the record capital actually reach the companies in our audience that are listening today?
The majority of the money is going to very few companies. And so the companies that we work with a lot, the companies, the Series A, the Series B, the Series C companies, they're really struggling to raise capital now, unless the numbers really support that. And so getting your fundamentals and getting the financials in order and having quality, durable revenue is more important than ever to take advantage of that smaller slice of the pie.
Welcome to the Aprio Ascend podcast, where we talk to the people and firms who aren't waiting for the future of professional services, they're actively building it. I'm Jordan Fladell, and today's episode is one I think every founder, CFO, and tech operator needs to hear right now. Because the headlines look incredible: record venture capital, a reopened IPO window, M&A activity at an all-time high, and yet, if you're trying to raise a Series A round, close a deal, or figure out what any of this actually means for your cap table and tax bill, the picture is a lot more complicated. H1 2026 broke every venture record on the books, and most founders are still finding it hard to raise money. That tension is exactly what we're here to resolve today. To help us do that, I'm joined by two people who see this market from very different vantage points. Simeon Wallis is the Chief Investment Officer at Aprio Wealth Management, bringing the capital market lens to what really drives these numbers and what they signal about where things are heading. And David Siegel is Aprio's technology industry leader, focused on what all of this means at the CFO's desk: the accounting, the tax structuring, and the decisions that will define how your company comes out of this moment. This is the Aprio Ascend podcast. Let's get into it. Simeon, the mid-year numbers are out. Give us the headline, then tell us why it's misleading.
Thank you, Jordan. It's an interesting question. U.S. VCs so far have deployed over $400 billion in the first half of 2026. That's already about 30% above where we were in 2025. But AI was the dominant factor. It's approaching 90% of that fundraise. And so when we think about it, most of that is actually happening in large-sized deals, 90% or more, over $100 million.
Wow. So David, does the record capital actually reach the companies in our audience that are listening today?
It's actually very interesting, Jordan. And actually, Simeon, based on what you said, I really concur in the sense that the majority of the money is going to very few companies. And so the companies that we work with a lot, the companies, the Series A, the Series B, the Series C companies, they're really struggling to raise capital now. And so we're starting to see the companies that raise money at the exuberant times of 2022, 2023 are not able to raise money in the current pace unless the numbers really support that. And so getting your fundamentals and getting the financials in order and having quality, durable revenue is more important than ever to take advantage of that smaller slice of the pie.
So Simeon, would you define this as a healthy market or a late cycle warning sign?
It was somewhere in between. We've moved off the bottom where we had a freeze in terms of venture capital deployment and financing several years ago after interest rates moved higher. Yet it's very much a concentrated market and it's AI or nothing. So roughly 90% of venture funding right now, AI dominated. And that has an impact in terms of those companies that clearly are not in the AI space.
So Simeon, just to build on that, we're looking at the IPO window in the M&A market. Is the IPO window actually open, or is it just open for a chosen few?
It's increasingly open. We've seen the chosen few essentially are opening the door for others, and the pipeline is getting better. But it's not a frothy market the way that one would assume if we went back several years ago to 2021, or if we went to the late cycle of the 1990s. So it's better than it was. It looks like it'll be strong moving forward, but we're really keen on those three big companies going public. SpaceX has already been able to do it, and then we'll see what Anthropic and OpenAI are able to do. They've filed their SEC filings, so then it's more, does the market really want to accommodate them?
That's interesting. David, for a founder weighing an IPO right now versus sale, what's the honest read from your lens?
The honest read is really the same as it's been for quite a while, in the sense that the vast majority of businesses do not IPO. And so though a lot of founders really have this IPO vision in the head and that they're going to be this founder of an IPO business, 99% of the time that doesn't happen. And so realistically, what we coach our clients with is yeah, you can have those great aspirations of being public, but also make sure you're dual tracking that. Make sure that you're seeing what's happened in the strategic world. And almost every one of our clients, their exit is a sale to a strategic, or a sale to a private equity, or a sale to another venture capital firm. So yes, the IPO market may be open, and yes, that's bringing more liquidity to the space. And yes, more companies will go public. That doesn't mean that that's going to happen to everybody.
So, Simeon, most of our clients aren't OpenAI or Anthropic. If 86% of the dollars are going elsewhere, what's the move?
The ecosystem of venture and technology is different than other sectors, and we have to understand that. When larger companies go public, what ends up happening is many of those longtime employees take those proceeds and they invest back in the ecosystem. They start investing in earlier stage companies, Series A, Series B, even seed and pre-seed funding. And what happens when we do have some of those larger companies have significant liquidity events, it ends up lifting up the boats over the next few years as many of those engineers look to go elsewhere, start new things, and then receive financing from people that they used to work with previously. And we're already starting to see that, Jordan, happening out in Silicon Valley. So there may be a period of time where things are a little bit quieter, but as we look out over multiple years, things do get better. What we'd also note, though, is not all companies are funded equally. We would expect that companies that are more geared towards industry-specific applications in the AI ecosystem are likely to be the biggest beneficiaries as we look out over the next several years. That means that the more horizontal plays may struggle a little bit, but where there's a real ROI for companies to invest or to procure those services and the technology, those are likely to be where the winners will be as we look at over the next few years in terms of venture financing.
Interesting. Putting the capital back into the market to make it work is a great approach, and definitely one we see regularly in the technology market. David, speaking of the technology market, as a former entrepreneur myself, this is a great question. Is the top opportunity right now to raise less and get profitable early as a real strategy, or is it a consolation prize in the market?
Great question, Jordan. So I think that we're seeing this play out in the real world. I think that we're seeing a lot of new startups enter the market. A lot of companies are being found that it's never been easier, it's never been cheaper to start a company. And so with all these big companies, big tech companies doing these big layoffs, you're going to see a massive scale of startups come into the market, and we're already seeing those play out. We're working with more and more of those every day, and our startup practice within our Aprio tech ecosystem is seeing 40% growth. And so I think a lot of that's coming from, yes, you don't need to hire as many engineers. You don't have to hire as many salespeople because some of the AI can help you with some of these things. And so what this is resulting, there's a lot of downstream ramifications of this. And so one, you're going to see a lot of new startups. A lot of them obviously aren't going to work out, but you're going to see a lot that try and that they get into the market, and then there will be some winners that come out of that. The other aspect of this is that these startups are entering the market with less need for capital because they're actually making money from day one. So the proof of concept stage is all happening vibe coding behind the scenes. And so when the company actually forms and you say, hey, I'm launching this business, you already kind of have a product. And yeah, it needs commercialization. And yes, it needs security and cybersecurity risk profiles and guardrails, and it needs a business plan and all these things that all startups need. But to get there, it takes a lot less cost and it takes a lot less time. And so what you see is these companies that make money sooner, and there's a lot of downstream ramifications of making money sooner.
Simeon, did you want to add something to that?
Yeah, we're actually seeing this show up in the data already. If we look at new business formations, they've accelerated significantly since 2025 as companies started to learn how to deploy AI internally and as people learned how to take it and really accelerate their coding capabilities. So what David said is already showing up in the numbers when we look at the bigger economy, and we're seeing it often in sectors where we might not anticipate. So things like defense tech are attracting significant capital, but we would expect with AI, you'll see it in things like cybersecurity too. And then on top of that, we'll end up with more of a barbell structure when it comes to financing. So the companies that David talks about, the early ones that are able to get towards profitability earlier, they'll attract capital because the numbers and the accelerated growth. The large ones, companies that are still private, will continue to attract capital. And so it's a barbell nature. If you're in the middle, that's where it'll be a little bit tougher.
Hey, actually, Simeon, I have a question for you on this. And so what is this going to look like when you have all these companies that need less money? And so the venture capital firms are going to say, hey, we want to invest in these great startups that are taking off, but they're like, I don't need your money because I'm already making money. And so what does that do to the venture world, and how do they react to the need for less capital to be deployed?
Several things will happen. We may see portfolios actually get larger with more companies in it. So they'll be able to write greater number of checks and maybe just not as large size, because some of the due diligence process now will be reflecting AI. Additionally, we'll see larger funding rounds at those later stage companies, which will attract more capital. That's almost like the pre-IPO capital. And so that's part of how this bifurcation will play out. Many more opportunities at the lower end, and at the larger end, you'll see just bigger check sizes.
So it's a flywheel effect where the need for less money creates the less money at the beginning, and it's going to create this bigger, the 90-10 split could end up even being more vast down the road because these earlier stage businesses don't need money.
So setting the market aside, Simeon, what changed on tax accounting that a tech CFO should be acting on this year? Is that the question you want me to pivot to David with, or would you like to answer that directly?
I would re-ask that question.
When I think about from an investment perspective, which is where I live most of the time, it's really understanding how to structure your own wealth, your estate planning, and how you think about how to segregate your wealth so that over time you can minimize the tax implications of these strategic rounds, especially when it comes to selling opportunities.
That's awesome. So, David, from a tax perspective, is there a deadline that people are sleeping on right now and should be aware of from an investment perspective?
Well, I think before we even talk about that, I think one of the things is that we are having to adapt, and we're having conversations with our clients at a different stage of their life cycle, is that because companies are profitable earlier, they're actually taxable earlier. And so for a lot of companies, choosing an accountant, choosing kind of advisors, choosing a tax accountant was more of a compliance thing, because in the beginning of the day, it's like you're losing money, you don't owe tax. So it's a check the box to make sure you get your tax return done. And we saw a lot of startups kind of go to low cost providers because they were able to provide the tax returns cheaper, and the quality of the advice didn't really matter as much because they weren't actually paying taxes anyway. And that was a future me problem. And so, but now with them being profitable earlier, it's a current me problem. And so how do we work with our clients, and how do we have the conversations with our clients sooner, and how do we be more efficient in a tax planning perspective, and how do we structure companies, work with them to structure their business and structure their kind of tax attributes of the businesses earlier is becoming more and more important. And working with quality advisors that have experience in planning for taxes and not just doing the compliance, but doing the advisory side is ever becoming more important. And we think we're really well positioned to help our clients with that.
Yeah, David hits on a key point in terms of thinking ahead around the tax side. In the investment world, there are additional strategies that have really become popular in the last year or two that enable entrepreneurs to essentially set themselves up to keep more dollars when they do have a liquidity event. And so being proactive in terms of getting those strategies in place, we see, especially with our technology clients, as being a bigger part of the conversation earlier on. And many aren't even aware that there are those strategies out there. So it's a combination of working with CPAs as well as investment professionals to make sure that they are.
So what you're really summarizing, both of you, is that your advisor at this particular point in the journey really matters more than it has in the past because of the complexity and the way the capital markets are working. So now we get to the fun part. You guys both get to play Nostradamus and predict the future. We're sitting here just the beginning of the second half of the year, known as H2 2026. And so, Simeon, I'll start with you. Then I'm going to go to you, David, to be ready for rapid fire. Does AI concentration soften in H2 or hold?
I would say the concentration softens.
Softens. Okay. David?
I think it actually becomes more acute. I think that we're going to see fewer big players. The frontier models, which we used to have 4 or 5 frontier models, seem to be down to kind of the final 2 that have the majority of the market share. And so I think that the capital requirements and the moat that some of these AI businesses have built around themselves are pretty substantial. And though, yes, it's easier to start a business. It's really still hard to scale a business, and the moats that some of these big hyperscalers and these big frontier models have built around themselves is not going to be something that that competitors are going to be able to break into as quickly.
Well, one of my favorite things happened. You both answered the question differently. So, Simeon, you had a different point of view. Why?
Yeah. I believe that if we start with CFOs, I think CFOs are going to really question the spending on tokens and the like, and they're going to look for alternative sources. And so we'll see things like open source models become more popular. At the same time, the barriers to entry by the nature of AI are much lower. And as a result of that, we're likely to see more startups out there. And so we'll go through a period where we believe you will see a fragmentation of what happens within AI. And then over time, you'll end up back again with a consolidation.
All right. Second question. We'll start this time with David. David, the IPO window, wider or narrower by year end?
I'm an optimist, so I think that Anthropic and OpenAI are going to have successful IPOs. They will go over $1 trillion. They will stay over $1 trillion, and that will keep the window open. I think that if those don't happen, the window will close pretty quickly, but I'm an optimist, and I think that it will play out.
Simeon?
I agree with David. Not just being an optimist, the capital that we need to build out AI infrastructure is just enormous. The best way to think about it is how much did it cost us to build all the highways in America in the 1950s and 60s, or to get electricity going in the 1920s so that it would touch so much of the country. And so the capital build out cycle is huge, and that requires public markets, whether it's bonds or stocks, private markets, whether it's private equity or private credit. All of this needs to be in the picture, and so the public markets will be accommodative.
I love the fascinating parallel to the power industry, because if you think about it, if the amount of capital was available back today that it was then, it would have taken 70 years for the whole country to get power available to it.
And yet, full circle moment, we're going to worry about power availability and limited resources of power now. So,
well, we're not talking about the environment today, so let's move along a little further. So, Dave, we'll start with you, Simeon. One thing that every tech CFO should do before Q4.
They need to do scenario analysis around how much tokens will cost for them.
Love that. David?
I think they're going to do that now. Hopefully they don't wait till Q4 to do that. I think all CFOs need to prepare for a future diligence. And so making sure they have robust controls in place, making sure that their revenue is durable, making sure their business model is sound. And I think that everyone's been scared into, hey, there's a doom and gloom cycle coming, that AI is going to take all the jobs away and AI is going to change everything. And I think we're 6 months probably past when that started. And I think everyone's a little more realistic now. And I think what Simeon said about token usage and token optimization, I think we're going to see a big push to token optimization and middleware coming to make sure that you're using the right model at the right time. And yeah, these open source models that Simeon mentioned are also going to be important, and making sure that proprietary data stays within an on-prem solution or within your own data center solution is going to be important. And so privacy and data security is going to continue to be more and more important. And it's been important, but it will continue to be more important. And it's hard to fathom that it can grow, but it's going to continue to become a bigger deal.
So if you think about what you just said there, and I want to pivot on this, and Simeon, I'm going to ask you a question. The market has been greatly impacted for SaaS companies. If you were to go look at the public marketplace and look at the SaaS decrease in valuations, they're quite significant. Do you see the market starting to recover and return that value to SaaS as AI normalizes in the near future?
There are going to be winners and losers out of it, even though everybody essentially now has been considered a loser. What's going to be important is how well SaaS companies can show that they take the threat from AI, they bring it into their development process and their systems, and they're able to show that the revenue growth rates and the margins do not get hit, and actually it's an accelerant to their business. Some businesses will do this a whole lot better. To the extent that they're more vertical than horizontal is one benefit. If the processes are more manual and rote in nature, that's also a benefit. If they're very much in a regulated industry, that can also be a benefit too. But they'll take some time, and it ultimately has to come down to, do the fundamentals start improving or do they get worse? And the ones that are improving will actually see re-rating higher, and the ones that will get worse, well, we'll see those multiples contract.
Love that advice. So David, if H2 holds pace, what do you see from your lens as the full year for the global funding land?
I think that Q2 will continue at the pace that Q1 has. I think you're continuing to see that these larger players will get the inordinate size of the capital, and the smaller companies will be okay with that because they're going to be able to be profitable and they're going to bootstrap themselves and they're not going to need as much capital. And the founders are already adapting. And if there's one thing that tech company founders are, is they're resilient and they are creative in ways to find ways around challenges. And that's what's made tech company founders successful for generations. And now the pivot is around capital and how that they work with new capital constraints. And I think that's good and healthy for these businesses.
So, Simeon, another question off the cuff here from that. I think when we talk about the M&A market, we've already started to see tea leaves of the big boys, i.e. the incumbents in the SaaS space, the large software companies starting to make acquisitions. Do you see that picking up in the second half of the year as maybe those startups and those great ideas start to become capital crunched down this journey?
We came into the year thinking that would be a strong year for M&A. It started slower than expected for everyone, every industry, because of what was going on in the Middle East. As that becomes more normalized, we would expect that the M&A environment would reaccelerate. Technology is a key component of it. With technology, there's always product gaps that need to be filled. Large companies under this administration have more flexibility in making acquisitions. So we do believe things are set up pretty well for the latter half of this year for acquisitions. And candidly, it's a place for many companies that went through private equity to get their exits.
That's awesome. So
we're actually, I guess just to add to what Simeon said, we're seeing that play out in practice. We're seeing not necessarily distressed deals, but hey, some investors see the writing on the wall, and so they're willing to kind of move on and sell their businesses sooner than they would have historically, at a decent price, at a good price, but not a fair fire sale price, though we are seeing some of those as well. But at a price that they probably wouldn't have accepted a couple years ago, but based on the current outlook, they're willing to move on. And I think that the buyers of that are really taking advantage. And look, just because something's on sale doesn't mean you have to buy it. And so the buyers need to be strategic to make sure they're not just doing a deal to do a deal, making sure that the deals they're doing are accretive.
So the saying that cash is king is still true. So we've reached the end here. This is my favorite part of every podcast. This is the Aprio Ascend moment. So I'm going to ask you, in the chair you have, you get to give one piece of advice to our listeners, knowing our audience today are probably listening in the founder space. They're probably in the technology space. What piece of advice would you give them, Simeon, as your Aprio Ascend moment?
Yeah. Most of the world I focus on has to deal with financials and cash flows and the like. Never take your eye off the ball when it comes to the fundamentals. It's all about ultimately how do you generate cash flows over time, knowing that you have some control over certain costs and really how to focus on those. You have certain levers to drive revenue, how to fund those. It's always about how do you ultimately allocate cash into the things that drive value and pull cash from the things that destroy it.
Love that message. Just like Nick Saban says, it's all about the fundamentals. David Siegel, your Aprio Ascend moment. What do you want to tell our audience?
Simeon kind of said what I was going to say, but focus on profitability, focus on gross margin. It's not the growth at all costs is no longer a thing, right? So market growth at a reasonable pace that is supportable by cash flows, making sure that your costs are in line. And I'm not saying that every company should be profitable. And there's a definite value to growth and multiples support growth, and durable growth is really important, but making sure that you're not too far out of pace. And I think over the last 10 years, I think we've swung in different pendulums, and I feel like we're back at a good medium spot, and continue that and take advantage of kind of all the different levers that they can pull to make sure that they're growing at sustainable paces.
Well, I want to thank both of you for your time. I know you're quite busy and have tons of clients and people banging at your door, so thank you for your time today. Thanks to Simeon and David for joining us today as our guests, and thank you to our listeners for listening in to the Aprio Ascend podcast. I'm Jordan Fladell, and we'll see you next time.